Complex financial derivatives played a key role in spreading damage from the U.S. housing collapse across the globe and helping spark the financial crisis. Those derivatives are a key focus of the financial reform law, but it's going to take a while longer now to write rules covering derivatives, also known as swaps. The Commodity Futures Trading Commission voted today to push back its deadline from July to the end of the year. Darren Gersh spoke with CFTC Chairman Gary Gensler about why the regulators need more time.
The American public needs us to move forward and get all of these rules in place. Congress gave us 1 year to do that. It's a complicated subject, and we've substantially finished proposing 51 of these rules, but it's going to take us some more time. We hope to be able to complete the final rules over the course of the rest of the calendar year.
So your supporters have said to me, he's the most aggressive regulator in Washington. Your critics say he's the most aggressive regulator in Washington. In fact, so aggressive that these rules on margins and the way he's implementing this Dodd-Frank Wall Street reform law risks really hurting American business. So what do you say to that complaint?
I say that transparent markets and well-regulated markets benefit the American public, benefit American businesses, ultimately help promote jobs. The financial system failed America, and the regulatory system failed. But what we know from prior failures out of the Depression, that well-regulated markets help promote the economy. And this market, this swaps market that was so much a part of the crisis, all we need to say is AIG, needs to have some oversight, needs a cop on the beat, needs transparency where people can see where these markets are. So I think what we're doing here actually helps business and helps America.
One of the things that happened during the financial crisis is we found out that a lot of these derivatives were very customized, very difficult to understand, very difficult to value. And I know one of the things that the law was trying to do is to make this more open, standardized, put things on exchanges. But can you do that with those kinds of very, very customized derivatives? And if you try to push them there, which some of the regulations are, try to push them to, becoming more like stocks where anybody can trade them, aren't you going to make it harder for people to do that business?
Darren, this sounds like some of the rationale why this market has not been regulated for 30 years. It's too customized and so forth. But in fact, probably 3/4 of the marketplace is quite standard now. If somebody wants to protect against a risk that interest rates move up and down, there's a standard product called an interest rate swap. And there are many, many of these in the oil markets as well. So that which is standard, we'd move to central exchanges and people would get a lot of benefit like they do in the stock market. Those things that are very customized still can do it. Corporate America can do that, and we allow that.
One issue that affects everybody in the country who uses oil, which is everybody, and also investors, is position limits on commodities. There's a lot of concern that there's speculators and it's driving prices up and down. You're proposing position limits, which basically means that investors can only have so much of the market. And how will that affect individual investors? Because one of the issues out there is if your a financial advisor says you should get some protection on commodities and inflation, and you go do that the big funds may not be able to actually buy the positions they want to satisfy investor demand.
For the longest period of time that markets have been around, people that want to hedge a risk meet speculators in a marketplace. And the Commodity Futures Trading Commission does not set prices, but we ensure that when that hedger and the speculator meet in a marketplace, it's transparent, open, and free of fraud manipulation. And we've had these position limit authorities since the 1930s to ensure that there's no one speculator with a very large position, that there's a diversity of points of view, and people meet in the marketplace. That's what we're trying to accomplish. They existed in the oil markets in the 1980s and 1990s. They went away in 2001. What we're talking about is reintroducing them. Congress has mandated it, and we'll get this done.
Well, with that, Gary Gensler, the chair of the CFTC, thank you for your time. I appreciate it.
Thank you so much, Darren.